Imagine waking up every morning knowing that your investments are working tirelessly for you, generating income while you enjoy the finer things in life. Welcome to the world of dividend investing for passive income. In today's video, we'll explore how you can build a steady income stream through smart dividend investments. First, let's define what dividend investing is all about. Dividend investing involves purchasing shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These payouts can provide a reliable source of income, making them a favorite among investors seeking financial stability and growth. Now you might wonder, what exactly are dividends? Dividends are payments made by a corporation to its shareholders, usually derived from profits. They can come in various forms. First, there are cash dividends, direct cash payments to shareholders. The company could hand out stock dividends, additional shares given to shareholders, thereby increasing the number of shares they own. These dividends are typically paid out on a quarterly basis, but some companies may choose different schedules. Understanding key terminology is crucial in dividend investing. What is dividend yield? This measures how much a company pays out in dividends each year relative to its stock price. It's calculated by dividing the annual dividend per share by the current share price. For example, if a company pays an annual dividend of $2 and its current share price is $50, the dividend yield would be 4%. You'll want to check the dividend payout ratio. This indicates the percentage of earnings a company distributes as dividends. A lower ratio suggests that the company retains more earnings for growth, while a higher ratio indicates a commitment to returning profits to shareholders. Then we have the ex-dividend date. This is the cutoff date to be eligible for the next dividend payment. If you purchase the stock on or after this date, you won't receive the upcoming dividend. Choosing the right dividend stocks involves careful consideration. Here are some criteria to keep in mind. Check the dividend history and stability. Look for companies with a track record of consistent dividend payments. Consider dividend aristocrats, stocks that have a history of 25 or more years of consecutive dividend increases. Or dividend kings, companies that have 50 or more consecutive years of dividend increases. For instance, Johnson & Johnson has been known for its reliable dividend payouts over the years, and there are many more. You'll certainly want to check the dividend growth rate. Companies that regularly increase their dividends demonstrate financial health and a commitment to rewarding shareholders. Coca-Cola, for example, has a history of raising its dividends annually. Their 3-year dividend growth rate is 4.91%. Look at the financial health of the company. You'll want to assess the company's earnings, cash flow, and debt levels to ensure it can sustain its dividend payments. In this chart, you can see the red lines, indicating the history of dividend increases for Johnson & Johnson. Their 3-year dividend growth rate is 5.37%. And here is the chart showing the dividend increase history of Coca-Cola. It's another strong dividend-paying company. When it comes to dividend investing strategies, there are two primary approaches. First, there are high-yield stocks. These offer higher dividend yields but may come with increased risk. It's essential to evaluate whether the high yield is sustainable. And then there's dividend growth stocks. These may have lower current yields, but they have a history of increasing their dividends over time, potentially leading to significant income in the long run. Reinvesting dividends through dividend reinvestment plans, DRIPs, can harness the power of compounding, allowing your investment to grow exponentially over time. Now here's a question for you. Would you prefer dividend growth or high-yield investing? Well, diversification is the real key to managing risk in your dividend portfolio. Spreading investments across various sectors can protect against downturns in any single industry. Combining investments in consumer goods companies like Coca-Cola, healthcare giants like Johnson & Johnson, and real estate through Realty Income Corporation can provide a balanced and resilient portfolio. Here's a chart showing what a diversified portfolio allocation could look like. And another thing, market conditions can influence dividend stocks differently. Defensive stocks, such as those in utilities and consumer staples, tend to provide stable dividends even during economic downturns. In contrast, cyclical stocks may offer higher dividends during economic booms but can be more volatile. You'll learn that risk management is paramount. Take some time and do your research. Here's some things to look for. Always assess the financial health of companies to avoid dividend traps where high yields are unsustainable. Tools like the dividend payout ratio can help determine if a company is overextending itself. And don't forget, There are various avenues for dividend investing. There's individual stocks, investing directly in companies like Coca-Cola or Johnson & Johnson. Or, how about real estate investment trusts? These companies, such as Realty Income Corporation, are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. Other very attractive options are dividend ETFs and mutual funds. Funds like the Vanguard High Dividend Yield ETF (VYM) or the Schwab U.S. Dividend Equity ETF (SCHD) offers exposure to a diversified portfolio of dividend-paying stocks. It's not heavy in tech stocks, and like a lot of dividend stocks and ETFs, it doesn't have as much volatility. Covered call ETFs are ideal for investors seeking to generate steady income while potentially outperforming in range-bound market conditions. These ETFs are particularly attractive to those who want to enhance their portfolio's income without taking on excessive risk. Two excellent options to consider are the J.P. Morgan Nasdaq Equity Premium Income ETF, JEPQ, and the NEOS S&P 500 High Income ETF, SPYI. Both of these are known for their high dividend yields and strategic covered call approach. You may also be interested in preferred stocks. These stocks offer fixed dividends and have priority over common stocks in dividend payments, but come with their own set of pros and cons. A few examples are Bank of America, Georgia Power Company, or Public Storage. Understanding the tax implications is also essential. Qualified dividends are taxed at a lower rate, while non-qualified dividends are taxed as ordinary income. Holding dividend-paying investments in tax-advantaged accounts like IRAs can help minimize your tax liabilities. Let's take a look at a real-world example of what could have been. Suppose you invested in Johnson & Johnson a decade ago. A $10,000 one-time investment in Johnson & Johnson on February 1, 2015 would have grown to $16,095 by the end of February 2025. However, be cautious of common mistakes. Be careful when chasing high yields. A high dividend yield can be enticing, but it may indicate underlying financial issues. Always research the company's fundamentals. There are numerous websites and internet tools to help you research a company. I use Seeking Alpha, but there are others available. ETFs provide automatic diversification by pooling a variety of stocks, bonds, or other assets into a single investment, spreading risk across multiple securities. However, if you choose to invest in individual stocks, you'll need to manually diversify your portfolio to reduce risk and avoid overexposure to any single company or sector. Don't ignore the fundamentals. Ensure the company has strong financial health and a sustainable business model. Dividend investing can be a powerful strategy for generating passive income and achieving financial independence. Select stable, growth-oriented companies and reinvest your dividends. You can build a robust income stream over time. If you found this video helpful, please like, comment, and subscribe for more insights. Remember, as financial expert Robert Kiyosaki once said, financial freedom is available to those who learn about it and work for it. Let's take those steps together toward building a prosperous future. This video is for informational purposes only and should not be considered financial advice. Always consult with a financial advisor before making investment decisions. Thank you so much for joining me today as we discover how dividend investing can generate passive income. I hope you found inspiration and value in every moment we shared. If this video sparked your curiosity or brightened your day, please consider leaving your thoughts in the comments below. Until next time, keep investing, stay inspired, and remember, every ending is just the start of something new.